What's up, everybody? Welcome back to another episode of Cipher Sessions. I'm Enrique.
I'm Yo.
I am Manolo, aka the Abundant Alchemist.
And today we
Welcome.
have a very special guest, Santiago Velez, who's the co-founder of Block Digital. So without further ado, Santiago Velez.
Hey.
Hey guys,
Welcome.
How's it
Hello.
going? Welcome
great.
to the
Thanks for
show.
having me.
Of
Appreciate it.
course. Well, so we appreciate you for coming on the show. We're huge fans of you here on Cipher Sessions. We've seen a lot of the content that you interviews that you've done. We follow you on Twitter. And so maybe we'll start off by just asking, so in some of the videos that we've watched, you make this reference to how you learned about the monetary system late in your life, and you wish that you had the ability to find out about that sooner. So I almost want to break that down into two sections, whereby the first question would be, why do you think it is that most people don't have access to understand the current monetary system? Is the first kind of tranche. And then the second one is just a high level overview of your understanding of the current monetary system.
Sure. Yeah. The first question, I guess I'd say, is largely to a large extent, there's really no reason, if your system is working correctly and as a citizen of a particular geographic area, you're being served well by the fiscal and monetary policies of your government. So, if everything's running smooth and there's no problems, you don't really need to know the underlying plumbing. I think when it becomes important is when there's kind of a recklessness or a transitionary period, which I feel we're in now, in which the actions of the central bank or the Treasury start kind of adversely affecting your purchasing power. Because at the end of the day, it's really not the currency that you have. It's real. How much does that currency buy you? Bring goods and services, the ability to pay your debts, the ability to accumulate wealth or at least protect that wealth. So to me, for the large part of my life, the economic system was fairly stable. In fact, I chose a profession that, as an engineer, was a pretty well-paying profession. Had 401k, a very stable kind of middle-class life, and I'm very appreciative of that. However, now with the advent of digital assets, cryptocurrencies, what became clear to me is that in the background there was this slow boil going on, and the first sign of that was the great financial crisis in '08, which in large part I was fairly insulated from, but that was the first real wake-up call, I think, in modern times, that maybe there's something broken with the plumbing. And we've seen subsequent really large shocks. In March of 2020, we saw a high volatility shock in 2018. We're seeing another big shock now with the situation in Ukraine. So all of these things are kind of, you're jumping on the ice, and every time you land on that ice, it's kind of building up cracks. And so if you don't know what your plan of action is going to be, assuming that ice breaks, what's your strategy going to be to preserve that purchasing power, to maintain your lifestyle or improve on it? You're going to find yourself in a lot of trouble. So that's kind of my answer to that first question. And so I feel that I had to construct that education myself through a lot of personal research, and it wasn't provided to me, right? As a citizen growing up in the United States, I was just conditioned to accept that the dollar is my currency. That's how I express value. That's what I need to accumulate. And ultimately everything will be okay if I just follow those kind of basic rules. And only occasionally did I get a glimpse of alternatives when I went and traveled in another jurisdiction and understood that they express value in a different currency. And there's this idea that currencies float relative to one another. There really is no fixed standard of value. There's purchasing power. So, so I hope that answers your question.
Yeah, for sure. And so then do you see that as the United States being the global reserve currency, they've had the ability to kind of make that monetary system ebb and flow to their advantage, right? After 1971, we kind of came off the gold standard, creating this world of debt creation. And so do you think that that was the starting point of the demise? Not maybe demise isn't the right word, but at
Breakdown.
that, yeah, kind of like the breakdown of the United States as a superpower, as it will, trying to leverage debt as an instrument to kind of keep this continuous flow of growth going.
Yeah, so I think a lot of people conflate the correlation of hard money like gold and the dollar as the primary mechanism of expressing economic power. I actually tend to disagree with that. If you look at, from when the dollar was decoupled from gold till today, the purchasing power of the nation has risen, and the kind of expansion of U.S. military power grew dramatically. The expansion of global trade and U.S. capital markets grew dramatically. So I think what happened there is that it became clear we couldn't pay our debts and obligations in gold denominated terms. So we started to realize that, okay, we're the reserve currency of the world, and the real let's call it intrinsic value of the dollar isn't bars of gold somewhere. It is the military, it is your economic power, your diplomatic power. It's all these kind of societal expressions of power, not gold. And so the problem, though, is that that's part of a long cycle, and that cycle encourages a lot of kind of externalities. And so we can't discount that in the long run, that currency could be devalued, right? That in exchange for our attempt to try to maintain the reserve currency status, that we overextend the use of the currency and devalue it. That's one of my big concerns, is that every major power before the United States went through the same cycles. You go back to the Dutch, to the British, to the Spaniards, and now to the United States. We've had these huge, large super debt cycles. We've had huge currency devaluations. We've had decoupling from gold standards. And it's just kind of this natural cycle that happens. And I think that we're in the latter stages of the dollar going through that. I actually, and I publicly said this on Twitter many times, I actually think the dollar is going to continue to rise. And that's because to this day, most trade globally and most oil denominated contracts, for example, are dollar based. So the demand for dollars continues to rise, at least in the short term, but eventually that becomes intolerable and people look for alternatives. And, at the same time that that's happening, we see rising powers like China. We see conflicts externally. We've seen that in Ukraine. And then we see internal conflicts in the United States, for example. So all of those things together diminish the purchasing power ultimately of the reserve currency. So I think we're at the point where nobody knows where the cliff is, but we're incrementally approaching that cliff. And there's a possibility that, first we'll get a big short squeeze, meaning the dollar will rage upward. It'll be prohibitively strong. And then people around the world will start looking for alternatives, and you'll see this kind of fracturing of the global reserve system. And, we're seeing this with Russia, with China. They're looking for alternatives. Russia, particularly, obviously, they're trying to evade the sanctions. And so they're looking for alternatives for world trade without having to use the dollar. So those, to me, are all signs of kind of a late stage cycle that the dollar and the United States is currently in. And so it's incumbent on me and your users to look forward and say, okay, what can you do about it? How can you adapt to this change, whether you like it or not, agree with it or not? How do you prepare yourself for that inevitable change?
Very, very interesting. I watched a video the other day where Ray Dalio goes into this explanation where he breaks down past superpowers and how they've had their reserve currency and how they've held it, right? And so he kind of gives these symptoms that, the United States is exhibiting now. And so I guess my question is, based on your understanding of blockchain technology and from past experience one superpower is replaced by another superpower, do you think that in the future this trend will continue where you'll have the United States maybe toppled by another superpower, or because we could use blockchain, maybe the power is spread globally and we no longer see this one um, uh, this power being
Monopoly.
centralized in one area?
Yeah.
Yeah, and yes, I fundamentally believe that. I think it is different this time. So, in the sense, all past cycles with regards to a reserve currency, a rise and fall of a nation state, relied on some major transition, some either a military conflict or economic conflict. And the successor then established a new world order, and everyone decided, okay, this is the easiest way to transact globally, right? To do trade. So it's really about friction. Right? If you're in an emergent market and you don't have the world's reserve currency as your currency, how do you trade your goods and services, your products from your country with other countries? What's the most efficient way to have bilateral trade? And that's typically a reserve currency, because you know that the counterparty risk is low, right? You don't need to rely on this other country whose currency you don't know its strength, that they don't secure the shipping lanes, they're not the major technology provider, all these things that come into consideration as to what makes a reserve currency. That's a lot of counterparty risk. So the simplest thing for most countries in the world to do is just adopt a single regime and use that, right? And it makes trade more efficient, it makes capital markets more efficient, and you get better globalization. But I think what is different this time is exactly blockchain, because blockchain has some inherent properties that never existed before. And so the transition from one reserve to another always had to be through kind of this, you reach kind of a boiling point, a critical threshold, things collapse through conflict, and then there's a reorganization period, a renegotiation period, and then you go on to the next currency. In this case, what I think is going to happen is we're going to enter a multipolar world where we'll actually have trade blocks between large partners. You take the BRICS, for example, Brazil, Russia, India, China, South Africa. They could establish very large trading blocks. You could have the West with Europe and the United States on the opposite side. And then you have all these emerging markets that are essentially caught in the middle, but still trying to do bilateral trade. So what I see actually is a bifurcated world of one reserve currency, the dollar, declining in power as maybe another reserve currency is rising. But ultimately, because of blockchain, all the other parties, everyone else, which is most of the world, can say, look, we don't need to adopt either. We don't need to continue to use the existing reserve if it becomes oppressive and it affects our trade adversely. And on the same token, we don't need to adopt this new currency that's on the rise, simply because we have a technological tool now that can facilitate the same reduction in friction. Remember that's the reason why people adopt the reserve, is this reduction in friction to support bilateral trade. If you have a technology that can do that, then there's really no need to adopt the new rising reserve either. So we know China has a CBDC in play. We know that the BRICS countries are setting up an alternative to SWIFT for cross-border value flow. So we know that this conflict is ongoing. The thing that's different now is that people have alternatives, and those alternatives are not geographically dependent, nor are they dependent on the behavior or actions of a single monetary or fiscal authority, a central bank, a treasury from a country. They are based on market forces, right? That there's a blockchain that is decentralized, that people around the world value it with respect to their currency in the way that they feel is appropriate. And so that's a market constraint type arrangement. I think that's a better arrangement. And ultimately, I think that leads to more peaceful outcomes. You don't have this tension necessarily between the declining powers and the rising powers. It doesn't force it to a head. It doesn't make everyone choose one or the other as things transition. And so we're very fortunate that we have this technology, because had we not, I think it would have been more like past cycles and more conflict.
Interesting point. One follow up to that. So in the future, where various countries, do you see various countries adopting their own blockchain? So you'll have individual countries with their own blockchain, and then there's a protocol in the middle that maybe links all the blockchains that allows for interoperability between all these countries.
Yeah, absolutely. In fact, I think that is the defining characteristic of this, eventually, of this new structure is an internet of value. So rather than everyone in the entire world operating under the same blockchain, for example, there will be a number of multi-networks that arise. And those networks are really about how those participants in the networks in the ecosystem navigate their own internal counterparty risks. So if you have a ledger that the BRICS use to establish trade balances and to establish kind of this currency, a bridge currency, that really only helps them in their internal subnetwork. It does very little for transacting outside of their network. So eventually you're going to need to interoperate between their networks and other supranational networks. And therefore you're going to need either bridge currencies or bridge protocols to allow that, so that you don't, again, build this counterparty risk, and that the transactions remain fairly low friction, low cost. And then eventually the networks will rise and fall. We see the analogs in the internet. You have networks that rise because the network effects are potent, and people, they see the advantage in the reach of their expression. I see the same with value. So if you join a large value network, your reach is very far, right? Let's take, for example, you joined a USDC dollar stablecoin network. Right now, that reach is pretty far, because it still represents the world's reserve. Not only that, but it can be sent over a blockchain very quickly and easily. And so if you look at the data, for example, in stablecoins, they've exploded exponentially, right? They actually are I would argue, the most successful digital asset right now in the digital asset space, because they already have a pre-existing, essentially, network effect, this global reserve currency. People will accept it. And they have the advantages of having the blockchain technology. I don't think that's going to last forever, that like the US dollar stable coins will continue to grow exponentially in that way. I think eventually they'll be subject to the same problems that the dollar itself, the euro dollar market, is subject to. And we'll see a short squeeze and then eventually a large devaluation. So what will replace that? It will be kind of this interoperable internet of value with all of these blockchains connected.
To the comment on stable coins, right? If central banks create a central bank digital currency, do you see stable coins and central bank digital currencies existing in parallel, or does the central bank digital currency kind of phase out the stable coin?
Yeah, that's a great question. And I think it depends on the geography, the jurisdiction, and what authorities those governments want to have over the money. Frankly, stable coins are in my view, at their current stage, are almost a type of counterfeiting, because they misrepresent the purchasing power of the dollar for the holder without all of the assurances that the sovereign provides, right? If the government prints a dollar and I have it in my hand as cash, for example, I know that that's a dollar, it's a real dollar. Whereas if, say Circle or Tether, they print a stable coin, there's counterparty risk there. I don't actually know that purchasing power is going to be equal to a dollar at all times. It looks that way. It's convincingly, it appears that way. But the reality is that there are huge counterparty risks there that in the traditional sense are not there. If I have a dollar in my US bank account and it's FDIC insured, I know that at least I have the huge body of law that comes with the government. I know that I have regulations. Whereas with stablecoins, at this point, we do not have that. So we could see the introduction of CBDCs. Let's say, for example, in China, they will not tolerate a Chinese renminbi, right? There's no way that the Chinese government, in the way that they are centralized, will ever tolerate private expressions of a stable coin version of the renminbi. They're going to want to have their CBDC used ubiquitously by all their big tech companies, all their payment rails. And they've already started along that path. So it's not us guessing that. That's just literally how they operate. Whereas in the United States, it's possible that because some of the technology providers are fairly far ahead, like you take Circle, they pretty much have figured out a lot of these payment rails, a lot of the tech stack, et cetera. It could be that the Federal Reserve just says, we're going to absorb you. So rather than the Federal Reserve going and figuring out all this technology stack, they basically just say, okay, Circle, you have to bend the knee. You're now going to be a private approved issuer of a retail version of a CBDC. And here are the rules that you have to comply with. Here are the rules that banks comply with. You're going to have certain capital requirements, reserve requirements, disclosures, maybe even subject to FDIC insurance. And so with all that comes regulation, and the business efficiency of an entity like Circle, their ability to innovate, move on lots of different blockchains like they have been, that's going to diminish because they're going to be hamstrung by the Federal Reserve, the FDIC, OCC. So that's kind of my view on where that's going. And I think things like Tether, there's going to be a concerted effort to stomp that out. It's bad enough that the Eurodollar market is so opaque as it is, but add on top of that, a stablecoin issuer that has failed to consistently provide assurances that it's backed by actual US dollars. It started there, it's moved to a mix of treasuries and dollars, a mix of investments in dollars. And so it's very unclear what the true counterparty risk is in something like Tether. And it's one of the things that concerns me the most with the digital asset market is those big unknowns. And we'll see similar things with Circle. It has far more discipline and it's US domestic, but it still has a lot of counterparty risk and doesn't actually operate like a bank. And we've seen earlier, end of last year, that the OCC forward signaled to the market that it's going to be reviewing these things. It's going to be reviewing banks that function with stablecoin providers, with crypto providers, and those that don't act responsibly in their view are going to be punished. They're either going to be deplatformed from the system, or the ratings that they give to their management are going to be poor. All that has consequences, and so we could see a round of essentially kind of deplatforming of a lot of these either exchanges, stablecoin issuers, et cetera. Let's see what happens.
You mentioned earlier, how blockchain can help, global conflict. I was just curious of how do you think blockchain can help our internal issues? And mostly, I mean, like the divisiveness between both parties, the Republicans and the Democrats. Do you think eventually we'll be able to vote on the blockchain? Because I think that, we won't have to technically vote for one representative, instead vote for policies like, climate change or foreign policies. How far do you think we are from that? Or do you even think that we'll end up getting to there at some point?
Yeah, that's a great question. I absolutely think the technology is perfectly suited for those kind of things. So let me break down how I feel about it. But so first of all, one of the biggest sources of friction in the last election cycle was the authenticity, of course, of the vote, and whether or not the people that did cast votes were legitimate, whether or not the number of votes that were cast were legitimate. All of these different rules that each state has with respect to their voting systems, whether or not that was executed legitimate, that was a main source of tension. And one of the things that blockchain technology affords is this idea of shared state. It's where you have a decentralized system where it is unarguable what is the true state of something. We happen to use that property for money in the sense that we always know who is the owner of a Bitcoin or an NFT or some other digital asset. We always know because the system arrives at consensus over who has what. And this shared state is very powerful. It's what imbues it with kind of this ability to hold value. You could do the same thing and apply those properties to a voting system where it's clear that the vote was executed properly. It was executed by an individual that's qualified to do so. That it's auditable. It has all of the provenance that goes with checking that it was correct, and you can always trace back and do your own independent sum and count. So I think those are incredible properties that absolutely could be applied. And there's a lot of counterparty risk, right? That gets eliminated. The idea that, let's say, a secretary of a particular state, is Republican and another state is Democratic. The two parties vying for power, could make accusations. Well, this secretary didn't actually implement their rules properly, and we're going to go to court. What introducing the blockchain does is it eliminates that conflict, because the rules of consensus established by the blockchain itself would eliminate the possibility that one party or another is implementing things incorrectly. Now, to get there, though, I think it's going to take a long time, because we need an identity layer that respects privacy, and we need a kind of a zero knowledge proof execution of, are you legitimate as someone who can cast this vote, and without revealing a lot of other personal information, like what your vote was. I think it's very important that as citizens, we maintain the right to privately know what our vote was and be able to verify, audit it, but no one else knows, right? So that way you don't have like political oppression. So it'll be a while, but I think those tools are there, and it's really just incumbent on us as citizenry to put pressure on our representatives to adopt it. Now, I think there's a little bit of a misalignment of incentives. Some representatives don't want that, because they currently they benefit from the uncertainty. They benefit from the misapplication of certain rules. So I think it'll take a while, but eventually that's going to be the only way that we achieve kind of a civil political transitions going forward.
That'll be awesome, and I can't wait.
And I just want to take one quick little tangent, because you kind of alluded to it, which is this idea that in the future we could vote on topics, on policies, rather than on representatives. And I think that's what I would love to see, and that's a form of your viewers may not have heard of this, but it's called liquid democracy. It's essentially where you can, for the most part, to live your life and make things simple, you can delegate your vote to a representative. But occasionally, when an issue comes to play that you are personally passionate about and you want to take part in the form of direct democracy, you essentially take your vote away from your representative in that instance, and then you apply it as a form of direct democratic representation vote, right? And so blockchain technology allows you to do that, and we're seeing that experimentation in a lot of DAOs, and this ability to kind of dynamically choose when you just want somebody to represent you for most things, or when you want to take that power yourself and weigh in on your own. It also allows for you to kind of apply your vote to somebody that you think is an expert on your behalf. So rather than just a representative who doesn't know really anything and relies on lobbyists, you can apply it to somebody who is an expert in that field or that you trust, and they vote on your behalf. So it makes it for a much more interesting democracy, in my opinion. And again, with tools like blockchain, all of that could be verified. That power could be carefully controlled, such that you as the private key holder, like think of it like your voting wallet, you always have the ability to either restore or delegate your vote. I think those are all really interesting, and possibly, it makes me hopeful about the possibility of using the tech for better governance.
I love it for accountability too, because right now they just promise us the world, and then when they get there, we have to kind of, we're at their mercy pretty much for like 4 years. So that's pretty interesting.
So going back to CBDCs, I haven't delved too much into it, but I'm just curious on your take. How would you see the Fed's ability to deal with inflation with this new tool under their belt?
Well, there's two kinds of CBDCs. There's a wholesale CBDC and a retail CBDC. Wholesale CBDCs are designed to allow interbank settlements. It basically makes the way that money flows between banks more efficient, more real time. One of the problems is that our current economic system has a lot of lags in it, has a lot of delays between payments and settlements, and it has a lot of banks and financial institutions like that, because they make money on that float, right? They like the delay, the fact that it's not efficient, because during that period of time that at least it's in their control, they can speculate on it or invest it and make some yield. So a wholesale CBDC is interesting for central banks because it allows it to make a more overall efficient financial system, and their banks run smoother. It's like a well-oiled machine. The problem, though, is that getting them to adopt that, they don't want that because they would lose a lot of money in fees and et cetera. So that's problematic. The retail version of CBDCs, which I think most people usually think of, that represents a systemic risk for banks, right? So you have your central bank and you have banks that facilitate credit creation in the economy. A retail CBDC means that the central bank essentially skips the intermediary banks. And so it represents potentially a systemic risk to the financial system and the banking system by skipping them. And the other problem is that central banks are not really equipped to assess risk at a large scale. They rely on the intermediary banks under their supervision and control to do that, right? To assess, are you credit worthy for this home loan? Is this business worthy? Is this investment a good investment? All of those kind of ongoing risk assessments, they rely on these intermediary banks to perform. So a retail CBDC skipping that would also introduce the problem of how are those risks assessed? You could maybe in the future have machine learning or AI do that. But let's assume a retail CBDC eventually arises. All of a sudden now, if that CBDC is programmable, this idea of essentially taking smart contracts from something like Ethereum, but applying it to a CBDC structure, you could program anything you want. So you could program behavioral incentives that don't exist now. So for example, let's say the central bank wants to stimulate the economy because we're in the middle of a pandemic. They could airdrop X number of CBDCs in your wallet, say, $5,000 worth, and then give you a time limit on it, meaning that $5,000 would decay over a month. You have to go out and spend it in a month or 5 months, whatever the criteria is, and it would decay off. And so it becomes a type of incentive system to drive your behavior. You now have to go and spend it. You can't save it quickly because that's what they want to do. They want to stimulate the economy in that particular scenario. Similarly, you could introduce negative interest rates, right? In the sense that if people are hoarding money in a savings account because they are afraid about the risks in the economy, that again would just slowly be eaten away by a negative interest rate. And then you could introduce social controls, right? If there's political repression that happens, the central bank could be used as a mechanism to do political oppression, right? That, maybe you're protesting against something or some kind of policy and there's no cash. All of a sudden now they can program in a more dystopian way. Well, you're going to be punished for, you're going to be isolated. Your wallet address, for example, is blacklisted until such time as you commit to the current political regime. So I wouldn't be surprised to see China doing that, for example, like blending their social credit system with their programmability of their CBDCs. And that's one of the things here in the United States we have to be very cautious of, that at all times, A, we maintain cash, and then B, we maintain the idea of private e-money. So rather than a CBDC, dollars that are issued by the Treasury, not the Federal Reserve, and those dollars essentially being privacy, having encryption on it, having the ability to be spent peer-to-peer. So all of these kind of properties that we already take for granted with cash, but brought into the digital world.
Excellent.
Just a quick follow-up to that. So in the future, right, where we currently are, and governments having the ability to just print money, quote unquote, print money, if you will, how do you reconcile the future under blockchain and these governments having this CBDC, but yet not allowing them to just generate these electronic dollars, if you will?
Yeah, I mean, right now, electronic dollars are already created by intermediary banks. People think that the central bank is who creates money, and that's actually not true. Most money is created, probably 3-to-1 ratio in credit creation, and credit is issued by banks. And the banks are the ones who really create the stimulus of the economy, the money flow in the economy. So a CBDC could circumvent that. It could be a problem where, in their intention to try to more micromanage the economy, they introduce this instrument that circumvents that credit creation process. And then, we have this massive problem, a massive deleveraging, right? Where there's no one lending, there's no one borrowing. And then it's all like the central bank trying to manage all of this, these incentives to get people to spend. So I think that's why central banks are so cautious. In fact, even just as early as today, Christine Lagarde of the ECB, the European Central Bank, was asked about CBDCs and digital currencies. And her response was the same thing, is basically they have a task force looking at it, how to apply it for wholesale, how to apply it at retail, how to interoperate those central bank digital currencies with other jurisdictions and other CBDCs. So they have a lot of people looking at it and figuring out how to use it correctly. I still don't think that changes any of the large secular trend in terms of fiat currencies, reserve currencies, those trends we were talking about earlier. No matter what technology they introduce, they're just putting lipstick on a pig. If those fiat currencies continue to be debased just through the process of credit creation and indebtedness, then their purchasing power will lower and people will start finding alternatives. So I see digital assets right now as essentially a check on central banks, right? And irresponsible monetary policy. If the policy becomes too repressive or irresponsible, then people will seek alternatives that are supranational and they're not constrained to their local geographic currency anymore. And I think that's one of the most interesting things here. And then what's different is that now people can check out. They have a vote of no confidence on their local currency. And it's going to be very difficult for the governments to do financial repression in the way that they've used to in the past, like capital controls or severe interest rates or yield curve control. It's going to be very difficult for them to do that when people have an alternative. And so that's what I think is new and different. And I don't think anyone can really anticipate how that's going to play out. I bet you they'll try to control the on-ramps and off-ramps. They'll try to put more and more controls on exchanges to whitelist or blacklist certain blockchain addresses that are transparent. And they'll try to go after things like DeFi and decentralized exchanges, et cetera.
I have a question in the energy sector. So with the push to go green and all the excess energy that we see that doesn't fit on the grid, do you think that's something that crypto mining could tap into? Because I know Oklo, I think, was doing something with like mini reactors. You think that's going to be a trend that's going to continue to grow?
Yeah, that's a tough question. So I think that there's an overall secular trend in just ESG, which is environment, social, governance. This ESG trend is a globally concerted effort. That means essentially energy austerity. If you're consuming energy for activities that aren't under the approval of the governments, and short of us moving to another planet, we're still subject to governance by these governments because they have all the guns and they control their geographies, et cetera. So if you're consuming large amounts of electricity in a particular geography and it's taking away from other economic activity, the government may or may not approve of that. I'll give you a simple example. After the Chinese shut down a lot of the Bitcoin miners, there's been a big migration into Texas because the electricity rates are so low, the taxes are favorable, you have a fairly libertarian style of governance there. The problem is that the Texas grid is an isolated grid from the rest of the United States. The ERCOT grid is isolated. And so ERCOT has seen a few major events in the last 2 years, one during a snap cold season where the grid went down because it wasn't winterized, and then another when there was over demand in the hot, in the summer season. In both those cases, that grid was strained and it was very difficult to operate it stably for its end customers. So in that case, I would not be surprised to see a political reaction if people are angry that, okay, you've got all these Bitcoin miners taking this many megawatts off the grid. Do something about this because my electricity bill is going up, 50%. If that, all that being said, there is a possibility that the economics of Bitcoin mining could be favorable to renewables, which is a type of interim power generation, right? Renewables, whenever the wind's blowing for wind turbines, whenever the sun is shining for solar, if you don't have a way to store that energy for when people need it, then you basically either have to shut it off or send it to somebody that can store it in an economic capacity. And so this is a lot of the narrative that, like Michael Saylor has been talking about, is that Bitcoin or mining in general can be used almost like an economic battery. Not necessarily, it can't store energy, but it can store economic value into the future and create more levelized incentives for power generation. So that way, if that wind turbine's spinning at 3 a.m. and making electricity, but nobody needs that electricity because they're all asleep, then you divert that electricity to mine some Bitcoin, you store that value in Bitcoin, and then eventually, when somebody does want to spend the electricity and not enough of it available, you could take that Bitcoin and essentially re-inject it back into the system and spend it. The only problem with that model is that the main beneficiaries of Bitcoin mining are not the people using the grid; it's the miners. And so I'm doubtful whether or not they would take that economic battery and kind of re-inject it back into the grid at the appropriate time. But it could still be a good incentive for solar and renewables to deploy, just because of the nature of how they generate electricity.
That's awesome. It'd be really cool to see, though.
Yeah.
So I've heard that Michael Burry has stated that he sees the equities market overpriced, something like 2 or 3 times over. What do you think that means for crypto, and how undervalued do you believe that the market is right now in contrast?
Yeah. Well, despite all the narrative about, being crypto being uncorrelated, that's been proven false in the last 6 months. I think that's self-evident to anybody looking at it. I also think that crypto has its own, bear and bull market cycles, but crypto has never existed in an environment of quantitative tightening. It's never existed in an environment of continually rising rates in the face of quantitative tightening. So, if you look at how long crypto and Bitcoin in particular has been around, since 2009, it's always been pretty easy to see exponential gains, right? Because all of this credit creation, all of this flow of money into the economy, it acts almost like a capacitor for some of that value, right? As a network, comparatively, it's much easier for crypto to grow than it is for dollars to grow in terms of purchasing power. So value tends to flow out of fiat currencies and into crypto when monetary policy is loose. But what we're seeing is probably a regime change here, where monetary policy is getting tight. We're seeing that with equities, and particularly in the tech stocks, they're all dropping. And it's because people know that maybe the spigot is being closed, no new money is coming, and these valuations for either crypto or tech were too high relative to the value that they bring their users. And so I don't think anybody can tell you what crypto is going to look like from a market perspective under a very tightening regime. Now, we could see some, crypto is small enough that you could see some really strange pockets happen. So, for example, if monetary conditions get too tight, and the wealthy, for example, let's say that they're worried about high tax policies, right? That's going to take a lot of wealth. They might decide, hey, this is this bridge currency that works anywhere in the world. I'm going to store a lot of my wealth in it while this, to avoid taxes, to avoid capital controls like we saw in China. So in a weird way, the tighter the government tries to make financial conditions to slow down inflation, you could actually see some of that value squeezed out into digital assets. I'm not sure, though, if that will play out that way. I think in the short term, it will continue to be a risk-off instrument. And I think that it's going to follow tech stocks until such time that prices get low enough where, value and bargain hunters start buying back in. I don't think we're quite there yet. I think stocks and equities have a ways to go down. And I also think that because of that, digital assets likely might have some bigger corrections and maybe even a bear market.
Very interesting.
Interesting. So with that comment, and then your prior comment of you seeing the U.S. dollar continue to gain strength for a while. So do you think we'll see something where, to your point, there'll be this correction in crypto, but a continued more or less upward trend in equities, or will it eventually reach a balance point?
I think they'll decouple. I think equity and crypto will decouple once. It all depends on the kind of people that are buying the crypto. If the kind of people that are buying into it are the same kind of people that are buying into tech stocks, it will remain highly correlated for a long time. But there could become a point where it's obvious that the devaluing of the currency is going to accelerate, and that at that point, people are going to be looking for safe havens, right? They're going to be looking for stores of value like gold and commodities. They're going to be looking at silver. They're going to be looking at digital assets. So it could decouple from the equities markets and then see a very large rise. But I think to get to that point, situation has to become pretty bad economically, and the devaluing of the currency has to accelerate. For now, it looks like the dollar continues to rise in strength. As of today, it was like the DXY was at 98, which is pretty high. We haven't seen it that high since March of 2020 when it had a short squeeze. And that dollar strength, the higher it goes, the more equities drop, the more digital assets drop. It's very coupled to that dollar strength. And with the situation in Ukraine and Russia, we could see even stronger dollar strength as it relates to like the euro because of the problems in the European Union and the risks there. So everybody wants dollars, and when they all want dollars, they'll liquidate whatever assets they have. They'll liquidate their stocks, their crypto, etc. But that could decouple, and we could see an inversion, and we see a flight into crypto.
Interesting point. I guess my follow-up would be, so then in the future, right, do you see it as the government's adopting the technology, or do you see it as people having an understanding that currency is being debased and then demanding the technology? So do you think it's a push by the people or a push by the government?
It's going to be both. I think it's going to happen simultaneously. I think governments are going to adopt certain aspects of this technology. For example, CBDCs, they won't be permissionless networks. They're going to be permissioned. They may be somewhat decentralized in the sense that, okay, maybe every Fed governor runs a node, and those nodes all arrive at consensus, and they help with settlement with like a real-time gross settlement system. We know the Fed is working on a real-time payment system, for example. So I think the governments will adapt it, and then they'll start to build supranational networks like we talked about earlier with the BRICS. Right. That doesn't give them the same properties, though, as a truly permissionless or decentralized network that's supranational. So at all times, this opt-out function that citizens will have will remain a compelling alternative, right? So no matter how much governments think that by adopting some aspects of this technology, they'll be able to catch up, the fact is that they'll never be able to restore confidence or the discipline in their currency in the same way that a private, decentralized, permissionless currency will. And so that competition is going to remain there forever, and the flows will go back and forth. It's not like we'll have this static one-way trend forever. It's that we're going to see narratives change and flows change between these networks. I look at currencies honestly as networks. The dollar is a network. The euro is a network, just like Bitcoin's a network, XRP is a network, Ether is a network. And it's just human beings deciding that the rules of that specific network right now are what I want and need. It has certain functions, it has certain reach, it allows me to express value in a certain way. Maybe it's preserving or improving on my purchasing power, but it's still a network, and networks have a narrative that they're responsible for. If that narrative changes, or if the gradient becomes too steep between one network and another, flows go in the opposite direction. So the key there is to pay attention to the narratives that drive each network, pay attention to how strong one network gets with respect to another, and then you'll be better positioned to take advantage of the gradient and the flow that will drive purchasing power in the other direction. So it's really about paying attention. And volatility is good in that sense, because if you pay attention, whichever network is kind of outperforming the other in terms of purchasing power, you can position yourself. And the switching costs are really low, right? I mean, it's basically just trading between one asset and another. So those switching costs make it easy for even retail people to take positions. The problem is if you hold onto a network because you have an ideological reason for it, you could be denying yourself the ability to acquire more purchasing power. If you believe in the dollar because you're patriotic and whatever, or if you believe in Bitcoin because of certain narratives, it might be a Bitcoin maximalist, you can tie yourself to a network and not see that there are changes in narrative that will drive the flows in another direction, and you've denied yourself. And that was kind of back to the beginning of this interview, is that's what I thought was denied to me. Is that I was fed a narrative that the dollar was the most secure and the best one to accumulate, and et cetera. And buying into a narrative forever is an error. If anything, it teaches you to be value agnostic and be pragmatic and look at, hey, which is the best right now and into the immediate future, and plan. So that's how I view it.
Interesting. I just had a thought when you were talking about that, and you mentioned Ethereum, XRP, Bitcoin. You mentioned these digital assets, and there is this belief where some people believe, well, my coin will be the dominant one, or it will be my coin that will be the dominant one. But if you think about it, to your point, how you view currencies as networks, then each individual thought, if you will, that thought that people have of Bitcoin, Ethereum, each individual group thought as a network will eventually just get to the point where they're interoperating globally, like irregardless of your belief in a quote unquote network, you'll be able to achieve interaction amongst other networks by having this interoperability.
I 100% agree. I couldn't agree more. And I look at these networks, these ecosystems, as kind of like an organism. And every organism has an immune system, right? Has a defense mechanism that when it perceives it's under attack, that it will react, right? It'll defend itself. And I'm wholeheartedly believe that most of the reaction that people have about their network and it being attacked is precisely because it needs to maintain a narrative dominance. It needs to make sure that value and purchasing power keep flowing into the network so that it keeps growing. Many of these networks are at the proto money stage, right? They're not really used as a medium of exchange, a unit of account. At this point, even the largest one out of all the digital assets, Bitcoin, is still struggling with a store of value. So these networks are all still essentially at proto money stage. And so they're almost like twins in the womb competing against each other, right? Kind of hardening each other, eliminating the weak ones. The stronger ones are evolving and growing and accumulating network effects, but they're still seconded to big networks, the fiat networks, the dollar, the euro, the larger financial system. And we see that as it correlates to equities, et cetera. Crypto is a tick on the dog, right? So until these networks get large enough where they can facilitate huge amounts of liquidity, they can solve really big problems for people globally, they'll kind of still always be riding the waves of these bigger macroeconomic trends. I think they'll get there. And I think the technology, many of the failures and many of the innovations that we're having in the technology right now are putting us on the path of getting there, to where these proto networks can actually get to a scale where they solve problems at scale in a supernatural way. And then nation states or individuals across geographies can really start using them in very effective ways. Until then, it's all about narrative flow and it's all about paying attention to which has the strongest narrative at any given time and trying to front run that.
So if I extrapolate that one level further, right, it's interesting that if you think of things as networks, then the current setup that we have globally is individual countries with their own networks in theory. And you can kind of almost overlay that with individual thoughts on independent currencies and how they kind of have their own separation. It's how do we create that middle ground where we're kind of reconciling networks, and what do you think could be, how would you see that network reconciling? Like, do you think that there would be one middle network reconciling all, or?
Yeah, no, that's a great question. And I like the analogy because I do think each nation state that issues their own currency is an internal network, right? That's how people resolve or buy goods and services and take care of debts and obligations internally. And it isn't until you get into an international transaction that you need some other mechanism. In this case, it's a reserve currency, but in the future, it could just be bridge currencies or interoperability standards. But so yes, I think fiat currencies are their own internal networks, and then they have to interoperate with other fiat currencies to a reserve. But I also think that digital assets, decentralized digital assets that live on the internet, that are supranational, they are their own nation states. They're small nation states, relatively speaking. Actually, some of them are bigger than real nation states, but they're in essence, they're nation states, right? You're part of the Ethereum nation, the Bitcoin nation, the XRP nation, whatever nation, right? And you identify with the rules of consensus of that nation, the values, the people who are building on it, and you identify with them in the same way you identify with your local nation state, right? What community associations how you vote,
Right.
how you bank, how you transact, what roads you drive on. So I think the analogs are very similar. And so I think we'll have a blended nation state networks, supranational digital asset networks interoperating. And the real question, I think what you're getting at is, do you think that eventually we'll all reach kind of an equilibrium? I don't, because that assumes that kind of conditions are unchanging after that the world's not changing, that some of these supranational digital asset networks aren't changing and going through their own internal dynamics. I think we're just going to see a lot more relative change between all of these networks, and the pace of technology is so fast that I can't imagine that a network just kind of becomes the one and only, or
Right.
that it achieves perfect stability. If anything, I think the market of supply and demand will continually determine which networks and their narrative flows will drive purchasing power. And so
Interesting.
it'll be supply and demand, and it will be, does this network solve a problem? How do my users of this network use it? And is that growing or decreasing? And how does that relate to competitor networks that maybe don't even exist yet, right? We don't even know how technology could change to introduce a competitor network at this point. So to call it a kind of end state at this point, or even close, I think we're going to see a lot of back and forth between these networks, growth and shrinkage.
Interesting. Yeah, I think that's an interesting point when you think about it and you describe the actual technology as an organism. Then, in theory, the organisms will try to thrive, and those that can thrive will thrive, and those that can't thrive almost will disappear, and something will almost pop up in its place. So,
Yeah, can I just quickly amend that?
yeah.
Let's take some analogs in the Internet of Information, right? And specifically point out switching costs, right? So switching costs are very high on other networks. So let's take, for example, Facebook. If you create an account with Facebook, the reason you did that is because it had certain network effects that allowed you to connect with friends and family, say, right?
Right.
If you wanted to leave Facebook to go to another competitor social network, the switching costs are very high, because you could leave and establish an account there, but your reach goes to zero. If your friends and family don't all come along with you, then that competitor network won't have really a chance to grow. And it's one of the reasons why, despite people hating Facebook and hating some of these other social networks, they've been able to maintain their strength because their network effects are so strong and the switching costs are very high. The difference with value networks is that purchasing power is a relative thing and it's an abstraction. The switching cost to go from one value network to another is fairly low and continues to lower. Like the number of exchanges, for example, continue to grow. The number of digital assets continues to grow. The amount of liquidity in each of the larger assets continues to grow. So the switching costs continue to lower between these networks as time goes on, which means that the ability of a network to kind of retain that network effect that like Facebook had, it's going to continue to diminish. And so it has to compete on merit. It has to compete on the properties that that network offers, either to increase or maintain purchasing power, to provide some service, to solve some problem. And if it doesn't, it's very easy for people to leave it. In fact, I could see a point where algorithms do that for us, right? I tell my algorithm, here's my risk tolerance. Here's how much purchasing power I want to accumulate over this time frame. Go to work, and it just goes out into the internet of value, and it path finds those networks that meet my criteria, and it just automates all of those switches for me. Right?
Interesting. So you mentioned, and I think I might be jumping around, but you mentioned pathfinders, and you've previously mentioned connectors, right? So in a world, this is going to be a fully loaded question. So in a world where we achieve full interoperability, right, where everything is just interoperating, I guess, do you see a point where, let's say you earn coins from gaming, you'd be able to interact with those earnings and buy something like a Starbucks, or you get to the point where you'd be able to maybe pay for dinner using Amazon stocks, because we've reached a point of interoperability where everything becomes liquid, but it's still loaded. Because my follow-up to that is, if you think of how we get there and there have to be pathfinders and connectors, then who become the pathfinders and the connectors to facilitate interoperability? Is it a combination of individuals and entities? That's loaded.
Yeah.
So sorry.
No, that's a great question. And I definitely think that's going to happen. I definitely think switching costs will continue to drop to the point where, look, they're all abstractions. If you look at Amazon points, if you look at rewards programs, if you look at dollars, digital assets, they're all just abstractions. They're a way that we as human beings temporarily hold value in something symbolic that somebody else recognizes. And the problem is, before, abstractions required that everyone agree everywhere. And that's not true anymore. As long as you have a technology framework, you don't need to agree that everyone doesn't need to agree that something has value, right? It's just that someone somewhere has to agree it has value.
Interesting.
And the systems will facilitate that. So that's a fundamental difference, because you're not geographically limited anymore. So yes, I absolutely think that all value abstractions, however, whether it's issued by a corporate, a permissionless private public blockchain, a private network, a fiat currency, all of these systems, when they become interoperable, their relative value abstractions will express purchasing power, and you'll be able to hop from one to the other. And then in that scenario, it's really how much friction is there, how much of the switching costs every time you hop. Now, there are going to be service providers, just like on the Internet of Information, we have internet service providers that route our emails, that route our video, that route the images. There are going to be routers on this Internet of Value that route value. And the ability for them to route value will be dependent on how efficient they are at doing so. Because if they're not efficient routing that value, another connector will take their place. They'll broadcast a better rate, and your value will just flow in that direction, because your algorithm, your pathfinding algorithm, will say, you know what, I could take connector number one, but they're charging me an excessive fee. Connector number two is trying to outcompete them. They're charging a lower fee, so my value will just be routed in their direction to get to the end state. Now, in some instances, you may be willing to pay a higher fee, because you might look at security as a premium, and you say, well, the amount of value I'm trying to transfer is high. Maybe it's at risk for cyber attack. I'm going to take maybe a more expensive route, but it's going to have a premium on security. but that's not true for all transactions. There'll be, micro payments, machine to machine payments, and, that absolute security won't be necessary. You'll favor more, economic efficiency on the routing path. So I definitely think that connectors will just spring up and they'll start competing. And we already see that in some form. Exchanges are very much like connectors for digital assets, right? Exchanges compete for, liquidity, for spreads, for how market makers are incentivized, how many fees they charge their users, but they might all trade the same asset. So, this exchange in Southeast Asia is trading Bitcoin along with one in the United States. And the way that's all levelized is with arbitrage bots. If one exchange gets too greedy or the price differential between the two exchanges grows too high, that gradient is quickly identified by an arbitrage bot and they'll close that gap. And so arbitrage, in a sense, allows all these different decentralized connectors to compete and route value, but eventually it levelizes them. So you have this kind of system of value transfer, this global system of value transfer.
I did have one question, so you kind of went into transactions, and I'm sorry, I don't want to take up too much of your time.
No problem.
Stuart Brand once said that the information wants to be free. How do you see Web3? Do you think all transactions and the overall experience, like with the metaverse, is going to be monetized, especially since like the advertising model is going to have to change, right? Because that's how, we kind of get a lot of the free things on the internet right now because of advertising pays for it. How do you see it in the future?
That's a great question. I think that we're at peak aggregator. And so to your point, most large social networks to date are funded by advertising. If you look at YouTube or Facebook or any of their revenue models are predicated on ad spend. And that means that ad spend it's there for a reason, that the network effects are they have viewers with eyeballs on their content, and therefore businesses look at it as a ripe place to display their products so they can converge on a sale. So if you change the dynamics of that network effect and you decentralize it, you could have some unanticipated consequences, not consequences, but effects. So for example, if a user is in charge of their own content and the distribution of that, maybe advertisers start paying users to watch their content. So rather than paying the network itself, an advertiser comes to Facebook and gives them money to show their ad, they just skip the network and go right to the user and say, hey, watch this ad, we'll give you 10 cents. And we're seeing things like that with Brave or with Coil, some of these other attempts at solving the ad problem. I think it's going to have to go deeper than that, because most of the internet is run by these data centers, right? And these data centers who stream the video and stream the pictures and the content, they're all run by ads too. And it's not like you can just replace those data centers overnight. Right. You need to decentralize the compute layer at the same time that you decentralize the ad layer, because otherwise nobody's going to serve the ads for free. And so we've gotten used to basically consuming content essentially for free in exchange for having to watch ads. And so that relationship might change, where you'll consume it, you'll be paid for it, but you're going to be paying for it at the product, right? When you go buy whatever that product is, you're paying for that advertisement. It has to come from somewhere. So I think it's very interesting. I think it could, there's so many different ways that could go. But I think the traditional Web2 internet has a lot of dysfunction in that sense, because it incentivizes extreme forms of aggregation. And we saw the problems politically with things like Facebook and what that means. Mm-hmm. And so I think that dysfunction is eventually going to reach a peak. And, decentralization offers at least the promise, not the guarantee, but at least the promise that users can bring back their data. Users can be the ones incentivized to participate, the ones who benefit from network growth rather than a few shareholders. So I'm pretty excited about Web3. I'm skeptical, but excited about it.
It's going to be interesting.
Super. Just to follow up with that, sorry, just my brain is. So then how do you see companies like Facebook, YouTube, because you made a comment on one video that I thought was fascinating, where you referenced like Hulu, Netflix, and how you pay monthly subscriptions, but in the future, you're going to be able to fractionalize that based on how much of that information you're consuming, right? So So how do these current platforms, I'm assuming they're going to have to pivot their business models, and how do they actually pivot to a point where it's lucrative to them, or do they just phase out?
Yeah, that's a good question. I think right now there's no incentive for them to pivot because right now they're just competing with each other. So the alternatives that would force them to pivot are not yet mature. So, for example, Netflix and Hulu and the rest are competing basically on what content is behind their paywall. The problem is that a single subscription subsidizes a vast majority of content that you never watch. So inherently, it's economically efficient. Like if I'm paying, $10 a month for a subscription, irrespective of whether I watch a second of content or 10 hours of content, I'm still paying that $10 a month.
Right.
So there's a form of subsidy. And the other problem is that we're kind of beyond the content horizon, right? Event horizon. There's more content on some of these content networks than I'll ever be able to watch in a human lifespan. And so it becomes more a matter of what content is popular, what content is engaging, et cetera. So they're having their battles in decentralized aggregators in that arena, that they're trying to make their content more and more engaging to attract them to the subscription subsidy model. But I think what it's showing, what it's kind of the signaling is, it's the content, not the content aggregator. And curating content so people have an easy way to discover it is a major problem, and they've solved that. But the other problem is that this subsidy problem, that they're subsidizing all this content you're not interested in and you're paying for. So eventually, maybe NFTs, some version of NFTs where content creators start directly monetizing their own content, and then through, like, say, a wallet-based system, you essentially just aggregate all the content that you're interested in. And so there's zero subsidy, right? So with a wallet, you just collect the NFTs that you care about for the shows that you're interested in, and that unlocks through a wallet-based system the content that you're passionate about. And so you're not wasting any money at all on content you don't care about. And so that will force a squeeze on the aggregators to essentially get rid of content that's not popular, shrink down their inventory, eventually to the point where it looks essentially the same as something I just described. And a great way to execute on that would be some kind of wallet browser embedded system where wherever my wallet goes, that's the content I want to watch, and either through a streaming payment or through like a bulk payment of an NFT, I can view just the thing that I'm interested in. So, like, for example, if I watch something on Disney Plus, I don't care about 90% of the content there. I just want to watch one thing. Right. Why can't I just pay a prorated based on supply and demand value for that in the form of an NFT, and then watch it? And then I want to go see something on a Netflix. My wallet is kind of my passport, right? So that's how I see it eventually playing out. But I think we have a ways to go. That's
super interesting. So I'm sorry again. Like, the follow-up would be, we're almost entering this phase of ownership coming back to the individual, where we're creating our own market price. So more free market as it actually should be versus what we're experiencing now, you think?
Yeah, absolutely. Because again, the technology layer is there for these things to start being built. We're already seeing NFT pluses, which are basically encrypted forms of multimedia. So just as a wallet holder, by having the private key, you're the only one that can unlock that media, right? And so that already makes it compelling for content creators to say, wait a second, why am I going through a distributor like a Netflix when I'm the one who made the content, which is the value? Why don't I just incentivize my viewers to watch it? Maybe I'll pay them to watch an ad. And then if they like that preview, that about my content, and I paid them to see it, then maybe now I can sell it to them and they can own it in a digital encrypted form and watch it. And so it changes the dynamic, I think, between the content creators, which, to your point, can go anywhere as big as a giant studio all the way down to a YouTuber at home. It changes the balance of power, I think, between the content creator and the content distributor or curator, which is the Netflixes, the Hulus, the Disney Pluses. And so that balance of power shifts more towards the creator, and therefore empowers economics that that creator can use to incentivize people to watch their content. So I definitely think it's gonna be super interesting to watch how that plays out. But I do think that's the overall trend.
Awesome. Perfect. I have one last question. So I think the crypto space kind of breathed a sigh of relief with this executive order. It wasn't like, the worst case scenario that people feared. There's certainly a couple of different landmines that crypto has to maneuver through to succeed. What would you say is the number one hurdle towards mass adoption in your view?
Yeah, I mean, I think for one, there's a huge barrier to entry on the technology level. So, for example, with all the innovation we've had, like in DeFi or NFTs or the learning curve is incredibly steep still. I should be able to go to my mother-in-law, for example. She's 80 something years old. I should be able to go to her and say, "Here, use this app," and she should be able to participate in crypto without this incredible learning curve. It's too steep right now. So I think that's a big barrier, is to get the UX, the UI down to the point, abstracted down to the point where the average person can engage with it very, very easily. That should be main focus. I feel like most of the innovation, which is okay, it's been under these new kind of financial products or instruments, but it hasn't been that much on the UX. That role has been largely played by the exchanges. Somebody buys a Coinbase app and they don't even understand the difference between custodial versus non-custodial ownership of your crypto. They don't get it. They just buy the app because they know they want the price to go up, and they use like a Coinbase app, and it's super simple to buy it and sell it. It's almost like Robinhood, right? But again, to really see the true benefits of digital assets, I think the designers need to really work on the UX and the UI to make it as easy for anyone, even a child, someone who's not used to the technology, be able to just pick it up and run with it. The other thing that I think, the other two things that I see is, again, we need more bridges built for interoperability, more bridges between networks, decentralized networks, and more bridges between decentralized networks and traditional fiat networks, or traditional, trade finance networks, traditional insurance networks, all these other kind of networks. We need more bridges built there so that value can start flowing and we can start to see that competition. And I think the final piece is going to be regulatory, where I think we need a lot more regulatory clarity about maybe how, look, every single digital asset, even Bitcoin, was created by a centralized party, right? There's no AI creating digital assets. It's all human beings, and it's always centralized. Somebody always has to have a plan about the rules of the game, how they're going to structure their network, and then how they're going to release it into the world and let it kind of grow. And so we need regulatory rules that recognize that everything starts off centralized, but over time it could become decentralized, and therefore not everything is a security, for example, or maybe not everything is a currency, maybe not everything is a commodity. And so we need almost a regulatory clarity on this asset class that has in of itself its own subdivisions of how these digital assets function and what services they provide, so that so builders can build with confidence and they don't have to worry about regulatory attack, or they know the rules of the game. They know exactly how far they can push the envelope. I think with that framework, that will lead to an explosion, because then every major brand and business, they'll start building and they'll start having the confidence to enter the space at scale. I can't tell you how many brands I talk to where they love digital assets and the growth and the community stuff, but they can't touch it because they don't have this regulatory clarity. So those three things, UX, UI, more bridges between networks, and regulatory clarity, I think will be the three biggest drivers for adoption.
Perfect. Thank you.
Well, Santiago, we had an amazing time. Very enlightening. We appreciate you taking the time to come on the channel with us. And we always like to end the show on the lighter side. So what I'll do is I'll ask you 5 rapid fire questions and you answer the first thing that comes to your mind. It's going to be a mixture of things.
Okay.
So you let me know when you're ready and we'll start.
Yeah, go ahead, shoot.
All right. First question. Favorite quote of all time?
Favorite quote of all time. That's a tough one. I think it's a Hyatt quote Maybe no. Actually, I think it's probably a Martin Luther King quote that leaders don't try to seek consensus; they mold it, right? So a true leader shapes consensus for a group, and they mold it, and then people follow. Versus just kind of leading from the back. We see a lot of politicians leading from the back. So yeah, I think it's a Martin Luther King quote.
Good answer.
Love it. All right. Second question. Favorite book?
Favorite book? I really like recently. I mean, it changes, as time goes on. But my favorite book recently is probably The Fourth Turning. I think it's fascinating, these cycles that they identified. I don't know if you guys have read it, but it's pretty fascinating and very forward-looking. The guy who wrote it was in the 90s, and it's almost spot on with how things are changing in the world. So, yeah, I think The Fourth Turning.
All right, I'll add it to my list of next books. I just finished, before the third question, I just finished 0 to 1 by Peter Thiel, and I just started Cryptonomicon. So
nice.
I'm working my way through that. All right, third question. Favorite place to visit?
Singapore, so far.
Ooh,
Oh, wow.
love Singapore.
I just like I like how they blended tech and nature, and it's just super clean and organized. And,
so you've had the chili crab.
Yeah. But it's so expensive, so that's the drawback. But I just love going to Singapore.
All right, and then this one hits a little closer to home since you're Colombian. When's the last time you had a bandeja paisa?
Like last week. There's a nice place here in near my house in Massachusetts, in Framingham. There's a great restaurant called El Pueblito that's Medellin type style food, and I just love it. It's like one of my favorite places.
How's the pan de bono? Good?
Oh, it's awesome.
So fifth question, and we'll end it off something crypto related. What is your current favorite digital asset?
My current favorite, XRP.
Yes.
I think just because a lot of people will be upset about that. I have a wide spectrum of digital assets.
Yeah.
But I think that one, from a price perspective, is probably best set up than any other digital asset, especially considering the regulatory attack that it's been able to fend off in the U.S.
Right.
So even though despite that, it's still performed incredibly well. That's Absolutely. A testament to the community behind it. So from my perspective, that's the one that I see with the greatest short-term upside.
But now that leads me to another question. That's why these things are.
We're gonna have to mute them at some point.
So, all right, just one. So, you were making a reference to, and maybe networks are different, right? So, like there was you incentivize people, but then David Schwartz has this saying, and I don't know if it's just specific to XRP, where he says the best incentive is no incentive. Is that just because of the fact of how you can create value? And because there's no incentive, you eliminate fees. Is that what you think he?
No. I think what he's saying there is that other networks secure themselves through an incentive system. So, for example, in Bitcoin, the Bitcoin network is secured through the mining process, proof of work, and that requires that you invest in mining equipment and you apply hash and you get the longest chain. And the problem with that is that ultimately that's not in alignment with the natural stakeholders of the system. So the natural stakeholders are the people who want to transact in it. They're the people who either want to store their value in a wallet, or they want securely, or they want to transfer it to somebody else. If there's an intermediary who extracts ever escalating fees like we see on Ethereum, that's an incentive that is contrary to the natural stakeholder. And so what he's saying is that if you start off with a low fee system, a system that the fees are there really just to deter spam or like denial of service attacks, then you can create a more equitable. People want to make forward progress just by the fact that they want this kind of neutral counterparty risk network to transact in. So I think his point is more around proof of work versus other consensus algorithms.
Yep.
The problem is that proof of work is really good at distribution, whereas other consensus algorithms, because they don't have an incentive mechanism, there's no clear path to how do you distribute that? How do you make it so that other people can acquire it without adversely affecting the value? And that's a problem, right? If you start with 100 billion of something, how do you get it out into the world without collapsing its value? How do you grow its value? And I think that's one of the things Ripple's struggling with, right? Because that's what the SEC is pointing at as, look, you have the vast majority of the value and somehow conflating that with it being a security. It's a distribution problem. So, Bitcoin doesn't have that. It's permissionless, so anybody can go mine it. Same with Ethereum presently. In the future, Ethereum, like when it goes to delegated proof of stake, they might have that problem again, because the only ones that will be able to receive value will be stakes, people stake against against a proof of stake validator. So each system has some problems with how does it distribute its value? How do you make that equitable and truly decentralized?
Got it.
Awesome. All right, Santiago Velez, thank you very much for your time. It was a great talk. Where could we and our viewers follow you?
I'm mostly on Twitter. I don't pretty much, and occasionally I do Real Vision interviews with various projects that I think are interesting in the digital asset space. So you can either find me on Twitter or Real Vision.
Excellent.
Awesome.
All right.
Appreciate you. Thank you so much.
Thanks for having me, guys. I appreciate it.
Please like, share, and subscribe, people. Any comments, please leave it underneath. And till next time, Cipher out.
Cipher out.
Peace.
Thank you.